You've made a couple of investments up into the Waterloo-Toronto region. So you talk about Figure 1, sorry. You talk about Wattpad, Kik. What brings you up to this region? Is there something that you look at or see when you are looking at Waterloo, or is it just that, you know, Kik happened to be here and so it fit our model and we're going to invest?
Kik was the first company that we invested in up here, and I'd always heard about Waterloo, and I never really had experienced it firsthand, and then came here and actually was in this building in 2011 and started to really get the sense that there's this incredible talent pool up here. And then we started looking at investments in Toronto as well, and the thing that became apparent to us is that you have a great combination of technical talent and also business talent in the Toronto-Waterloo corridor, and it's only an hour flight from New York, and it's easy for us to come here. It's easy for us to be engaged in the companies that we invest in up here, and of course that's what we like to do. So all that's a big positive. And then the other thing, which is I think good in a way and not good in a way, is I don't think that there is nearly as developed of a venture capital community here in Toronto Waterloo as there is in Boston or New York or San Francisco or a number of other metro regions in the United States. That's good for us because we can see a lot of high quality opportunities come our way. It's obviously not great for the entrepreneurs because they got to work harder. They got to go to New York, or they got to go to San Francisco, or they got to go to Boston to try to raise capital. I'm not saying there's no capital here, because there is, and there's some good investors here, but there aren't that many, and so that actually is an advantage if you're an investor.
But you've watched over 25 years the VC community change and evolve very significantly in New York. Have you seen any of those parallels here? Are we on the early stage of a growth and uptick in VC, do you think, in the Canadian market? Or do you think because so many of our great companies go down to New York or San Francisco that we'll continue to have to rely on them for so much life support, so to speak?
First of all, the three companies that we're invested in Canada right now don't seem to have any interest in leaving Canada. So I don't think you have to leave to build a great company, and so that's an important fact. There's enough talent here. Like, if we had a company in Des Moines, Iowa that ultimately had to leave because they didn't think that they could recruit the talent they needed in Des Moines, Iowa to build a great company. But Toronto is one of the top 5 or 6 cities in North America. Is that right?
Yeah, absolutely.
I mean, so there's clearly enough talent here. That's not a question, and you can recruit people here too. So I think that the thing that's still missing from this sector is active angel networks, active seed funds, and to a slightly lesser extent, more traditional venture capital firms. The thing that really made New York turn into a great place to do startups was when there became enough angel investors and enough seed capital. Because it's that first $1 million, $2 million that you got to put together to get a team of 5 or 10 people and get a product in market. And if you can't raise that money, it's not going to work. And venture capitalists honestly don't provide that capital for the most part. And so that's the thing I think that this region still really needs more of.
Well, I'd love to hear your thoughts on that, Ted.
Yeah, so I do this like once a month consumer lunch where it's like 3 companies or 4 companies, it's very few. And they're always asking, like, we talk about like vision, so product stuff, people, and then money. And for money, I'm always like, yeah, money, you're pretty much screwed here. Like, you're pretty much gonna have to go to New York or San Francisco where people are willing to take bets on these consumer companies. I think a big part of that is Waterloo hasn't had a big exit. Like, there's BlackBerry, but that was built over 30 years. So like, those guys are like, listen, nobody gave us a break, why would we give you a break? I'm not saying that's what they say, but that's what I would say if I were them. Whereas like you have companies in San Francisco who are like, yeah, somebody irrationally bet on me. 3 years later, I exited, I got $100 million. I will irrationally bet on you. So I think that's the first big part of, or that's the biggest things Waterloo's missing, is like a big exit where people can sort of irrationally put money back into the community. But then, yeah, like that, the other thing is like, what can we do before that? So that was like the Velocity Fund and trying to do stuff there, like provide some seed capital to sort of get it started here.
Well, the other thing that, so you're right, like the best seed and angel money comes from former entrepreneurs who've been successful, who've made it, and who want to take some percentage of their gains and pump it back in. And it's not altruistic. I mean, they want to make money too, right? But they get it, they've seen it, they know there's value in doing that, and they do it relatively easily without putting you through crazy hoops. But the other place it could come from, and it has started to come a lot from in New York, is the broader business community. I mean, there's certainly a lot of people in the Toronto-Waterloo corridor who can invest in real estate projects. There's certainly plenty of people who work in the financial markets, whether they're managing mutual funds or hedge funds or whatever, and these people have capital. But in New York, they weren't willing to invest in startups for a long, long time until they started to see repeated winning, and then they said, oh, I'm going to jump in there and do that too. So I actually think there's a lot of capital in sort of the wealthy tier here in Toronto Waterloo that could come in and provide some of that angel and seed capital. But it's going to take a few successes to get them to do that.
One of the things we're starting to see develop a little bit here that we saw in San Francisco, and I don't know if it's the case in New York, is that a lot of investors, when a venture failed, there would be an acqui-hire type exit that still put a good chunk or most of the money back into the investor's hands so they could play again. And most of the time, if a company fails here, it's like, oh, they failed, we should go poach all of their employees, and you just don't see that kind of organized exit for a lot of the companies.
We don't have that so much in New York. That's not really in the mentality of the New York angel and seed community the way it is in the Valley. The reason is that there's a dozen or 24 big companies, from Dropbox to Twitter to Facebook to Google, although Google doesn't really do this very much, that are going to be willing to pick up a team of 10 people that have demonstrated they can work together and they can build something and ship something that's actually pretty good. But it just doesn't, I don't think that really happens anywhere else other than Silicon Valley.
So your firm has had fantastic success coming in very early at the A round and then taking all the way to IPO and seeing companies go through that significant transition. We just had one of our first companies in Canada, Shopify, go past that $1 billion mark and then planning for IPO. But most of the time, exits from Canada will happen via acquisition long before they get to that $100 million mark. This is one of those things that at least keeps me awake at night, worrying about we're starting to build 1, 10, $50 million companies, and how do we keep that momentum and sustain that so they get to the IPO and create the kind of exits that fuel this community?
Well, we have that problem in New York too. Too many of the good companies in New York decide to cash out via an acquisition as opposed to going all the way for an IPO. And we've started to solve that problem for entrepreneurs by creating liquidity along the way for the founders and the management team. Not tremendous amounts of liquidity, but enough liquidity so that they can buy a home and think about sending their kids to college and all that kind of stuff and take off some of that financial pressure. It's a lot to ask somebody to. It's 10 years. I don't know when did Shopify get started? Like 2007?
Yeah, 2005.
2005. Okay, perfect. So 10 years later, they're now thinking that they could go public. They probably can. So that's what it takes. There's some companies that can get there a little bit more quickly. I think for Facebook, it was like 8 years. But really, it's a 10-year grind. And there aren't that many people who can stick it out for that long when people come along and start dangling money in front of them. And so the only way I think you can incent entrepreneurs and the management teams that they create to really play for the long haul is to provide some liquidity along the way. And it has to be done in a way that people are still motivated, that you're not making people fabulously rich, so they can just sort of slack off. But that's a good approach. And investors don't like doing that until they see that it actually benefits them, and then you start to see people do more and more of that. So that's something that I think you probably want to see more of in this region.
I'd love your thoughts on that too, Ted, because you get to see it front row.
Yeah. So for me, it's always been building a big company. Part of it's taking the financial pressure off, but to me, the biggest thing, so we actually did something like this in our last Series C fundraising round. And to me, the big reason was not to take the financial pressure off per se, but I think the bigger problem was people just didn't appreciate how much the stock they held in Kik was worth. You're in Silicon Valley, everybody's like, oh, I had a friend who was early at Dropbox, and now they're worth this much money. Whereas in Canada, it's like, I don't know what options are, but what's my salary? Like, it's almost like we could just give them 0 options and they'd be fine with that, which we've never done because we want everybody to be a shareholder in Kik. So for us, at our part of our last round, we let everybody sell 5% of their vested stock because we wanted everybody to know just what that was worth. And people were like shocked. Like, they're like, really? Like 5% is worth this. So if I multiply that by 20, it's worth that? And I'm like, that's correct. So
you did get a math degree.
Yeah, and we and we did that, and we did it for everybody. We even gave like co-ops a small cash bonus because they didn't have any shares, so we wanted everybody to be part of it. And then to make it like super fair, we, me, Chris, and Peter, who's our CTO and our CFO, COO, actually gifted back $20 million worth of shares back to the team. Because when we sort of looked at what everybody would get, everybody's doing that math like, okay, this times 20 is worth what I'm worth. You got this times 20, that's what you're worth. Wait a second, I'm more important than you. Why do you have that? So we smoothed out that curve. We came up with like an equation for how long you've been here, which is the risk you took times how much money you make when you were here. That's the value you bring. And we brought everybody up to the same curve. And that took $20 million worth of stock to do it, but we did it because we thought it was right.
Wow. So many ways you're my hero, Ted.
Yeah, we're crazy. We're a crazy Kik.
Yes, crazy because you were 23 and you donated $1 million to all these future students who are going to go make this place wonderful.